Welcome to Buzz Lab Updates. Subscribe and press the bell icon for more updates. The headlines screamed from every screen, bold and unforgiving, as if the nation itself was being shaken awake from a dream. German auto giants exit America, declared one news ticker, its letters burning into the public consciousness. Markets plunge as BMW, Mercedes, Audi abandon US. The financial world reeled, with investors scrambling to make sense of the chaos. The news felt less like a business announcement and more like a seismic shockwave, rippling through every home and workplace. Across the country, the familiar hum of industry was replaced by a deafening silence, as if the heart of American manufacturing had suddenly stopped beating. In Spartanburg, South Carolina, the BMW plant saw its gates locked for the first time in decades, a symbol of the abrupt halt that stunned the community. Thousands of workers were met with grim-faced managers and notices of indefinite suspension, their futures thrown into uncertainty overnight. The vibrant energy that once defined this manufacturing powerhouse had vanished overnight, leaving only echoes of what once was. At the Port of Baltimore, thousands of newly imported Mercedes-Benz and Audi vehicles sat gleaming under the harsh lights, destined to be shipped back across the Atlantic, never to touch American roads. The decision by Germany's Big Three sent a tremor through every level of the American economy, from Wall Street to small-town dealerships. The sheer scale and speed of the withdrawal were breathtaking, leaving communities and industries scrambling to adapt to a new reality. The question on everyone's lips was simple, yet profound. How did we get here? What chain of events led to this unprecedented exodus? The silence was more than just the absence of noise. It was the sound of an era ending abruptly, leaving a void that echoed with uncertainty and loss. The catalyst for this unprecedented crisis was a single decisive policy action, one that would send shockwaves through the global economy and alter the course of the auto industry for years to come. The Trump administration announced a sweeping 25% tariff on all imported automobiles and auto parts from the European Union, a move that stunned both domestic and international markets. The policy was designed to protect and bolster American manufacturing, aiming to revive domestic production and create new jobs for American workers. For the German automakers, this tariff was an existential threat to their American operations, putting their decades-long investments and thousands of jobs at risk almost overnight. A BMW X5 assembled in South Carolina relied on a significant percentage of high-tech components imported from Germany, making it especially vulnerable to the new tariffs. The 25% tariff applied to these critical parts, inflating production costs to unsustainable levels and forcing automakers to reconsider their entire supply chain strategy. The automakers pleaded their case in Washington, arguing that they were major U.S. employers and exporters, and warning of the devastating consequences for both the industry and the broader economy. Their arguments, however, fell on deaf ears. Lawmakers remained unmoved, unwilling to reconsider the policy despite mounting evidence of its negative impact. The administration remained steadfast, convinced that the short-term pain was a necessary price for long-term industrial revival and a stronger, more independent American economy. The tariff, intended to be a tool of negotiation and leverage, had instead become a trigger for a complete market withdrawal as European automakers began to pull out of the U.S. market entirely. The policy designed to bring jobs home had, in a stunning turn of events, just sent tens of thousands of them packing, leaving factories dark, workers unemployed, and communities reeling from the fallout. The announcements came in a rapid, brutal succession. BMW Group declared an immediate halt to all production at its Spartanburg plant. Mercedes-Benz parent company Daimler announced the wind-down of its assembly operations in Tuscaloosa, Alabama. Audi confirmed it would also exit the market, halting imports and shuttering its corporate headquarters in Herndon, Virginia. The immediate impact on the workforce was a devastating blow. The severance packages and official statements offered little comfort in the face of such abrupt economic dislocation. Beyond the direct employees, the operational shutdown was a logistical nightmare. The companies initiated a massive and costly process of repatriating assets. The message was clear. This was not a temporary pause, but a permanent departure. The giants of the German auto industry had packed their bags and gone home. The departure of the German auto giants triggered a catastrophic domino effect. The most immediate victims were the hundreds of franchise dealerships across the nation. Showrooms that were once bustling with customers fell silent. Service bays faced a future with no new vehicles to sell and a dwindling population of existing ones to service. The shockwave then hit the vast network of American suppliers. For every job on a German automaker's assembly line, there were an estimated 7 to 10 additional jobs at supplier companies. This led to a second, much larger wave of layoffs, hollowing out entire communities. The intricate web of commerce that supported the auto industry began to unravel with terrifying speed. The economic prosperity that these foreign investments had brought to their communities was being undone. The promise of protecting American jobs had resulted in the destruction of a complex and thriving economic ecosystem. As the doors were closing in America, new ones were opening wide in Asia. The German auto giants executed a swift and decisive pivot to China. The Chinese government, eager to position itself as the global leader in automotive technology, rolled out the red carpet. This strategic shift wasn't just about moving production, it was about moving the future. Billions of dollars in investments were funneled into brand new, state-of-the-art factories in China. The top engineering talent and innovative research projects once based in the US were relocated. The synergy between German engineering and Chinese manufacturing scale created a formidable new force. By deepening their presence in China, BMW, Mercedes, and Audi could lower their production costs. They were building cars in China for the world, bypassing the United States entirely. The trade war, intended to secure American technological dominance, had inadvertently accelerated the rise of its biggest competitor. The tariffs were supposed to be a shield for America's domestic automakers, protecting jobs and boosting the industry's strength at home. But the reality turned out to be way more complicated and painful than expected, with consequences that rippled through every level of the industry. The same 25% tariff hit a huge range of critical components that U.S. automakers were importing, from electronic systems to steel frames and specialized parts. American companies had to make a tough choice: either raise their prices and risk losing customers, or accept lower profit margins and absorb the extra costs themselves. The prices of American-made vehicles started to climb, eroding the competitive advantage the tariffs were supposed to create and making it harder for families to afford new cars. Instead of a sales boom, U.S. automakers saw demand soften, with fewer people walking into showrooms and more buyers holding off on big purchases. The policy didn't really help them. It just made the entire industry less competitive, leading to layoffs and uncertainty for thousands of workers. Without the fierce competition from BMW, Mercedes, and Audi, there was a risk to innovation and quality, as American brands faced less pressure to improve. The global ambitions of U.S. brands took a hit too, as their vehicles became less attractive in overseas markets due to higher prices and strained relationships. The European Union, in response to the U.S. tariffs, slapped their own retaliatory tariffs on American-made goods, escalating the trade conflict and making it even harder for U.S. automakers to compete abroad. The tariffs, meant to show American strength, were actually isolating its own champions from the global economy, leaving the future of the industry more uncertain than ever before. The crisis of 2025 hammered home just how complex modern manufacturing has become. The auto industry relied on the global supply chain model, sourcing the best parts worldwide. But the tariffs took a sledgehammer to this finely tuned machine. A new, more fragmented model started to take shape: the regional supply chain. Companies had to rethink everything about their manufacturing strategies. The new goal? Regional resilience, not global efficiency. For the US, it meant a frantic rush to bring production of critical parts back home. In the short and medium term, this led to huge bottlenecks. The global model had encouraged intense competition among suppliers, driving down prices and pushing technology forward. The seamless world of auto manufacturing had been fractured, maybe for good. The American tariffs kicked off a chain reaction of international retaliation. The European Union responded fast and hard, slapping heavy tariffs on iconic American products. This move shut the European market to many American exporters. The trade war, which was supposed to protect American industry, ended up actively hurting a wide range of American businesses. The geopolitical fallout was just as bad. The trade dispute drove a wedge through the transatlantic alliance between the United States and Europe. Trust and cooperation gave way to suspicion and economic conflict. This division played into the hands of other global powers, especially China and Russia. The global car market was changed forever, creating a more divided, less efficient world. The trade war didn't just trigger an economic crisis. It redrew the map of the global auto industry. As the dust settles, the United States stands at a critical crossroads. The immediate picture is bleak, with tens of thousands of jobs gone. The policy that was supposed to spark an American manufacturing renaissance triggered a meltdown. One possible path is to double down on the America First strategy, turning inward. It would take huge investments to replace all the lost capacity and know-how. In the meantime, American consumers would face higher prices and fewer choices. Another route is re-engaging with the global economy, repairing relationships with key trading partners. This approach recognizes that no country can be an island of innovation. The future of the American auto sector might depend on its ability to adapt and innovate. The challenge isn't just to rebuild what was lost, it's to build something new and more resilient.